How secure is our investment in a money market fund where from the asset allocation schedule, the fund manager has assigned a huge percentage of that asset under management, probably a 75%, 80%, and in some real case, a 90% to a certain asset class. Are there risk exposures to that? What about the management fees and the money market fund returns? Is it an element that we need to consider when we are comparing the performance of the money market fund and maybe another investment option like the Treasury bill or the Treasury bond? We also have another question that is very important, and this one looked at the other incidental costs related to these investment options. And a good example is an RTGS cost when you are transferring your funds to CBK for purchase of a treasury bill or a treasury bond. We have other costs related to depositing your money in a money market fund. We also have costs related to access of that money from that money market fund. And do you know that some fund managers will charge you an extra access fee when you exceed a given number of withdrawals from your money market fund? Do you have an idea of a specific money market fund that will charge you 500 shillings if you withdraw more than once from that money market fund? If you know such money market funds, tell us in the comment section. If you don't, I will be telling you one of such money market funds towards the tail end of the video. But let's look at these three important questions that we have gathered from the comment section of our previous video comparing the money market fund and the treasury bill as in investment options, and we were looking at where you are going to get more from your investment to help you accelerate the growth of your capital. We shall exhaust those three questions after 3 seconds break, so don't go away. In the meantime, give us a like to this video and engage in the comment section, because we have always said that our comment section is our suggestion box. We will always come back there to look at what could be your questions that we can answer through a comment, or maybe questions that would require we do and video to answer. And our viewers will also be answering some of those questions from the comment section as you guide us on what you would like us to be talking about next. See you after 3 seconds short break. Welcome back, and thank you for your likes and comments. If you are new to the channel, give us your subscription and don't forget to hit the notification button so that when we upload our next value-packed video, YouTube will send you a notification. The first question that we are going to look at is from Felix Ekemboy, one of our 100 subscribers. And Felix is asking, what about the 2% management fee in money market funds? When you put that into account, treasury bills become better. The observation by Mr. Kemboy is looking at the management fees as a cost that we need to have considered when we are comparing our investment of 100,000 as an example in a money market fund and a treasury bill. And our view of the channel, the fact about management fees is that management fees are deducted before the returns from the money market fund are declared. That means that those interest rates that you are given by the fund managers as your daily return or the annualized return from your money market fund, they are already net of the management fee. That would mean that if, for an example, Saiton is giving you a 15.8% return, it means that Saiton from the investments, they are getting a return of 17.8% because you get that return from the investment at 17.8% minus a 2% management fee to get the return that is supposed to be shared or distributed to the members of that particular fund or the investors. So the answer to Kembo is that the returns that are given are always net of the management fee. And this is inclusive of other expenses related to the management fee. We have a good example as the ZD and the Mali money market funds, which they will give you the management fee as 2%, but there are other fees related to the other parties, the investor ecosystem, that is the custodian and the trustees. That means that the total management fee that will be deducted before the rate is given will be the sum total of the identified management fee plus the custodial and trustee fees. In the case of a fund like the Saiton Money Market Fund, which charges a ledger fee, the ledger fee is not part of the management fee. Ledger fees will be deducted on a monthly basis after the distribution of your returns. So such an expense like the ledger fee can be used when you're analyzing your options for that particular money market fund. We have another example that I had said I would disclose at the end of the video, and it's a fee which is chargeable as an additional access fee when you exceed the required or the given withdrawal times, then that one can also be considered. And that is when you are taking into consideration to compare a specific money market fund with your treasury bill option. But in general, management fees are the same, not in terms of figure, but in their treatment from the returns. Not to forget to mention that for those members of Sanlam Money Market Fund, your management fee has increased from 1.5% to 2%. So expect either the fund manager retain your returns at the same point, meaning that they will be getting much more from the investment, or the obvious expected is that we expect the Sanlam returns to go lower and possibly they will have to be pushed down in the performance charts. The second question relates to the incidental expenses, but this is a question by Peter Kaduo, and Peter says that consider other costs like RTGSs, bank transfers, M-Pesa, etc., which are involved during the transactions. The RTGS expenses relating to the treasury bill payments will be quite important to consider because that is unique, and as an investor you have no option. There is no other way you can pay for your successful bids other than RTGSing your payment to CBK. So that particular incidental cost relating to the treasury bills, that one should be considered in your eventual evaluation. But when it comes to the money market funds, you have a wide array of options that you can use in wiring your investment or depositing your investment in your preferred money market fund. And a good example, or the most important thing for an investor, is the understanding that to maximize your returns, then you must make sure that you minimize the incidental expenses relating to your investment. And because the options that you have, some would require no fees or will not charge you any extra costs to make your funding or purchasing units in the preferred money market fund. And a good example, as an investor, if you have identified a specific money market fund that you would want to use as your parking point for your investment cash or capitals, because or your emergency funds, then you can choose to hold your investment account with that fund manager's custodial bank. Because when you are transferring money from your account to the custodian account in the same bank, that is an inter-account transfer. Such transfers are free of cost. The only thing that will be attributed to that transfer as an expense is the exercise duty and the stamp duty of 2 shillings. You also have the M-Pesa options. For example, if I have cash that I would want to deposit in a money market fund, if I'm on ZD platform or the Mali platform, that is generally the M-Pesa platform, depositing my cash into M-Pesa is free. and transferring those funds that I have deposited in M-Pesa to the respective money market fund, whether Mali or ZD, will also be free. Look at the other option. If I have cash that I want to deposit in my money market fund, if I work with that cash to deposit directly into the custodian account of my fund manager, such deposit will also be free. The only expense that I will incur is maybe the cost related to communicating to the fund manager of my deposit for it to be credited into my account. So it is your choice as an investor to identify the most cost-effective means that you're going to use to make available your investment to your custodian account for your respective money market funds. So those incidental expenses relating to the money market funds, we cannot have a standard way of incorporating them in our analysis because they are heavily dependent on you as an investor. But as an advice to the channel, look for the most affordable means of depositing or purchasing units in your money market fund. The third question, which is very important, is from Maureen Muturi. First, we appreciate the compliment that our work in the channel is truly impactful, and that is what drives us to continue doing more of this content. Please do a video on fixed deposits in terms of fund managers investing their funds with the banks. How risky is it for a fund manager, like she has specified a specific fund manager there, investing 90% of its fund in bank deposits? What would happen if the bank collapsed with these funds? Please shed more light. Are there guidelines from CMA on how a fund manager distributes their portfolio across various asset classes? The first important thing that we need to identify or deduce from that question, we need to distinguish between the custodian bank. This is the bank that holds the collection account of the fund manager, where we are depositing our money for purchases of units. We need to distinguish that bank with the bank where these amounts are invested, because it doesn't mean that the fixed deposit investment by the fund manager are to the same bank that is also our custodian. That is not the case. So after that, the fixed deposit investments are in other banks and not the custodian bank. With the custodian bank, we'll always have a specified balance that will always sit in that account. And remember, we have the incoming amounts of deposits as others are getting to withdraw from the same account. So there is always a balance that has been to be maintained in that account for purposes of enabling those transactions, especially the withdrawal transactions. Then the rest of amounts are allocated to different investments, asset classes, and one such asset class is bank-related deposits, whether it's a fixed deposit or the call and demand accounts or deposits. And as an item number two that is important with these questions is that there are regulations by the Capital Markets Authority with regard to investments. The principle of diversification, not putting all your eggs in one basket, is very well understood by the fund managers. And in this case, then, when we identify a certain chunk, percentage of the assets under management to have been invested in a particular asset class, in most cases, that amount does not sit with one bank. The fixed deposit is not held in one bank. It is spread across several banks. That is an effort to minimize the risk exposures. And we appreciate the observation with respect to the risk related to collapsing of a specific institution in where we have invested the funds. It can also be a corporate or a company to which we have lent our money or we have purchased a corporate bond from. If all the asset allocation percentage given in the asset allocation schedules relate to just one company, then that would pose a risk. So the fund manager spreads the amounts that have been the percentage allocated to corporate bonds to not just one company. And the same happens with the fixed deposits. Such amounts as to extent of 90% cannot be held under one bank. That amount has been spread to several banks for purposes of risk minimization or mitigation. On the side of the CMA regulation, the regulator requires the fund manager to at least hold a minimum of 4 spreads for those asset classes in order to minimize the risk exposures to the extent that at the very worst, the assets under management, the highest risk would not surpass at 25% in the asset allocations. We appreciate those 3 questions. They are very important. And at the beginning of introduction, we said that we would talk about this money market fund that charges you an extra fee when you exceed a given number of withdrawals. And that one we are referring to Avocap. Avocap charges you extra 500 shillings if you withdraw more than once from the money market fund. So get informed by watching our next video. Thank you for watching.